All right, today we're going to break down one of the most talked about turnarounds in India's energy space, Reliance Power's massive 5-year strategic pivot. This is the story of how a legacy giant is trying to transform into a green energy leader, and we'll look at the whole journey from 2021 through 2026. Wow, okay, this one slide really tells the whole story, doesn't it? Back in 2021, you can see the balance sheet was just drowning in red liabilities. Fast forward to 2026, and it's a completely different picture, a sea of green equity. Now, this is way more than just a change in accounting. It marks the end of an era as a distressed asset and the beginning of a new life as a recapitalized, debt-free company. So the big question is, how in the world did they pull it off?
So let's dive right into that. We'll start with the bull case. What's the optimistic view? What's the foundation they're building on for future growth?
The very first step was taking decisive action on their debt. Just look at the steep drop in liabilities on this chart. Between 2024 and 2025, the company went in and aggressively settled with its major lenders. We're talking ICICI Bank, Axis, DBS. They effectively wiped the slate clean, getting rid of that distressed balance sheet that had been holding them back for so many years. Now here's the thing. Even during the toughest of times, the company had a secret weapon, a powerful cash engine, the Sasson Ultra Mega Power Project. What you're seeing here is its plant load factor, which is really just a measure of its efficiency, and it has consistently stayed above 90%. This is a huge deal. This plant wasn't just keeping the lights on for the company. It's actually a critical piece of the puzzle for India's entire national grid stability. So with that stable foundation in place, the focus could finally shift to growth. And the bull case really hangs on this idea of an asset-light expansion into renewables. The plan is, well, it's ambitious. They want to nearly double their capacity from 5.9 to 10 gigawatts by 2030 with a laser focus on green energy. A key part of this green expansion is getting back into big, high-margin projects. And when I say big, I mean massive hydroelectric ventures, like the 1,200 megawatt Kalai 2 project you see here in Arunachal Pradesh, and another major project in Bhutan. Now, sure, these things take a very long time to build, but it signals a really bold re-entry into large-scale renewables across the entire region. But it's not just about generating more power. They're actually trying to fundamentally change their business model. This diagram here shows their pivot to what's called energy as a service. The basic idea is to use their huge land banks to host green data centers for global tech giants and then power them with their own renewable microgrids. It's a really smart shift from just selling a commodity to selling a complete energy solution. So the big question is, are we actually seeing results? Well, this chart gives us a pretty good clue. Q3 of fiscal year 26 showed a solid 12% year-over-year jump in consolidated revenue. This suggests that the new focus, combined with the surge in India's peak power demand, is already starting to pay off. So when you put all of these pieces together, the zero debt, the new ventures into battery storage, and getting those old legal battles resolved, they all combine to build a new strategic moat. And this isn't just about playing defense. It's a powerful signal to institutional investors that the company's newfound stability is here to stay. But of course, no turnaround story is ever that simple. To get the full picture, we have to flip the coin and look at the bear case, the big challenges that could still derail this growth story. And the skeptics are definitely not quiet. They're quick to point out the warning signs. And these aren't just minor hurdles. We're talking about these are significant execution risks that could seriously challenge the company's ability to deliver on all these promises. Let's break them down. First, those massive hydro projects we mentioned, they take years to build. That means a very long wait before they generate a single rupee of revenue, and that can really test investor patience. Second, a big chunk of their current revenue still comes from coal, which is facing huge pressure from carbon taxes and ESG mandates all over the world. And finally, the stock is heavily owned by retail investors, which makes it prone to really volatile swings that can be driven more by market sentiment than by the company's actual performance. So, after weighing the compelling bull arguments against these pretty significant bear risks, what's the final analyst verdict on Reliance Power today? The consensus verdict is actually pretty clear, and this gauge sums it up perfectly. Reliance Power is no longer seen as a distressed asset or a value trap, one of those stocks that looks cheap but never actually recovers. It has moved firmly into the turnaround opportunity category. But, and this is a really important but, it has not yet earned the title of a compounder. That's a company that delivers reliable, steady, long-term growth year after year. For now, analysts are viewing it more as a cyclical play, and they're advising caution until the revenue from those new green projects actually starts showing up on the profit and loss statement, which likely won't happen until late 2026. And this leaves us with the one crucial question you have to consider. Has the company truly ring-fenced its past? Meaning, have they completely insulated themselves from their old problems? Or do the very real execution risks of this ambitious green future just pose a completely new kind of challenge? That's really the core tension to watch going forward.